So a closed-end fund was the original mutual fund. So it's a commingled investment vehicle where you have shareholders, you have a professional money management team that is selecting the underlying stocks. It could be bonds, it could be equity REITs. But what's unique about closed-end funds that differs from an open-end mutual fund or an ETF is an open-end mutual fund, for example, is what we're most familiar with in a 401k plan. It trades at the end of the day. So the fund sponsor figure out who wants to buy shares, who wants to sell shares. They net it out. They figure out the price of all their underlying assets. And then you exit or enter that fund. The market price equals the net asset value, which is the total assets divided by the share prices. Closed-end funds work differently. They trade on an exchange, just like an ETF does. But there isn't a mechanism to make sure that the value of the assets, the net asset value per share, equals the market price. And so there's some advantages to that because then the fund sponsor has this set pool of capital. They can invest in maybe some more illiquid securities. They can use leverage. But the challenge or the opportunity for us as individual investors is that we can buy these funds at discounts to their net asset value. So you could buy a bond fund that's selling at a 15% discount to net asset value. And closed-end funds, they're a smaller market. So what I like about them is they're not a market that hedge funds can play in. You don't see a bunch of institutional investors buying them because they just can't get the liquidity. So most owners of closed-end funds are individual investors, which means, and one of the things that I'm always asking about, and in my book I talk about this, is to ask who's on the other side of the trade. Because investing it's a competitive game, and we want to know who's selling us a particular investment. Just like when we buy a house, who's selling us a house or who's selling us a car? What do they know that we don't? And with most investments, typically, if hedge funds or bots or institutions are involved, they know more than us as individual investors. But with closed-end funds, it's other individual investors, and they tend to panic in a market environment like today. And so they sell these funds. They're not sure necessarily what they're owning. And so then you see these discounts widen, and then that becomes more of an opportunity for us.
That's really cool. So I guess, mutual fund space, ETF space, I think of like the big names like Peter Lynch and his mutual fund from the 90s that had crazy returns. Today, it's like Cathie Wood and the ARK fund. Are those closed-end funds? Are those open-end funds? What are the difference or similarities between those more popular funds and the ones you're talking about?
So the Peter Lynch fund, the Fidelity, those are open-end mutual funds. ARK is an exchange-traded fund, and I should probably extend my analogy to exchange-traded funds. So exchange-traded funds are like closed-end funds in that they trade on an exchange, and you can see the price disconnect from the underlying net asset value. But with ETFs, you have what are known as authorized participants. Basically, institutional investors that are always looking at the price of the ETF compared to the net asset value, which gets published every 15 minutes when the market's open. And then they can buy and sell the underlying securities, or what's known as a reference basket, as well as the underlying shares. They can short them. And so all that arbitrage allows ETFs basically to stay in line, the price to stay in line with the net asset value. And so Cathie Wood's ARK Innovation ETF, I think it's ARKK, that's an ETF. Now it's distinct because it's an actively managed ETF, whereas most ETFs are passively managed. They're seeking to track a specific benchmark. But ARK is heavily active, very technology focused, certainly down 60% year to date, but its price will stay close to its net asset value, where with a closed-end fund won't. And I mean, some of the big sponsors in closed-end funds are BlackRock, Nuveen. I mean, there are a number of big-time sponsors. And one of the other differentiators with the closed-end funds is they tend to be leveraged. So they're borrowing money to leverage up the underlying assets to magnify the returns. So they tend to often be more income-oriented. So you'll see distribution yields of 6, 7, 8%. And that's where they can be attractive. So we can pick up a yield at 6%, 7% in an asset class that, it's selling at a discount to its underlying value of 15%.
Is it as simple as finding those close-end funds that are trading at a discount and buying them and selling them when they are fully valued? What kind of a strategy have you found tends to work well when talking about these kinds of investments?
Well, what we're trying to find is a closed-end fund whose discount is greater than average. And so if you go to a website like CEF Connect, you can screen, it's free, you can screen based on the biggest discount, and they calculate what's known as a Z-score, and it's basically a statistical measure, and Morningstar reports the same thing. Basically, it's how big is that discount relative to its average? And so when I'm investing in closed-end funds, I'm typically looking for a Z-score of -3 or less. In other words, so it's -4 or negative, well, you probably don't get more than -4, but generally it's more negative than -3. And that typically shows that the discount is greater than average. So that's an opportunity. And then the other thing to consider is just recognize, is their dividend sustainable? So if they have a 6 or 7, 8% yield, that dividend has to be funded somewhere, either out of the income, out of gains. And so it's just, just like if you're going to analyze a company to invest in a stock, there is some due diligence required on closed-end funds just to understand, whether that income is sustainable or that dividend is sustainable.